Hi, I'm Shiloh Bates, and welcome to the CLO Investor Podcast. CLO stands for Collateralized Loan Obligations, which are securities backed by pools of leveraged loans. In this podcast, we discuss current news in the CLO industry, and I get to interview key market players.
The content here is for informational purposes only and should not be taken as legal, business, tax, or investment advice, or be used to evaluate any investment or security. The views expressed in this podcast are those of the guest and do not necessarily reflect the views of FlatRock or its affiliates.
Today I'm speaking with Chris York, a partner at SLR Capital. SLR is an independent boutique asset manager focused on direct lending with expertise across a range of primarily senior secured financing solutions for U.S. middle market companies. That's according to their website. Chris is an expert on business development companies. So given recent headlines, I wanted to get his perspective. BDCs are a close cousin to CLOs, and there is some overlap on the underlying loans owned by the two. We discuss if private credit is as attractive as it used to be, why public BDCs trade at substantial discounts, oversubscribed BDC tenders, the risk in software industry loans, and declining BDC NIM. NIM is net interest margin, which is a difference between where a BDC lends and its financing cost. So that's profits. Some housekeeping items. I'm always looking for interesting guests to have on the podcast. Email us at info@flatrockglobal.com if you'd like to come on. I recently put out a white paper and YouTube video on captive CLO equity funds. You can find those on YouTube or the FlatRock Global website. If you're enjoying the podcast, please remember to share, like, and follow. And now, my conversation with Chris York. Chris, thanks so much for coming on the podcast.
Shiloh, we've known each other for a while. Thank you so much for having me.
So why don't we start off with your background and how you ended up in the BDC space?
Sure, I'll spend a couple minutes on it. So I've spent my career entirely in financial services, and my background has been focused on the U.S. middle market corporate lending landscape and the regulatory arbitrage and ROE relative value provided by banks and non-banks in their business models. The arc of my background involves three phases and follows the evolution of the public and private markets and ultimately the growth of BDCs. First, as a corporate credit analyst. Second, as a publicly traded equity research analyst covering financials. And then three, where I'm at now at SLR, as a product developer and investor relations advisor within a broader alternative investment manager. So in 2006, I started my career at LaSalle, Chicago, corporate credit analyst in their 2-year rotational program. At this point in time, this was right before the GFC. LaSalle was owned by ABN AMRO, and my time there was heavily impacted by the GFC, and LaSalle was later sold to Bank of America. I ended up placing in Bank of America's real estate capital markets program, which has a lot of overlap with CLOs, and there's applicability in terms of the demand for that product, which began to soften as cracks in mortgage-backed securities began to emerge. I think what's interesting from my perspective in terms of what I learned there is how different underwriting standards were being taught to me as a credit analyst and what we were required to hold on LaSalle's balance sheet. And then secondly, the credit standards that were permitted to be distributed to investors in the capital markets. The GFC happened, I moved to equity research, and I spent the next 12 years covering developments between banks and non-banks for public market investors. I first covered commercial banks, including State Street and Northern Trust, which later became systematically important, and then moved to covering non-banks as banks were essentially uninvestable to public market investors. I pivoted in 2011 and 12 with my coverage to remain more relevant to public investors as I thought the puck was going to non-banks. And I first began to cover mortgage REITs in 2011 and then expanded in 2012 to cover BDCs. And that's ironically, I think, where we met when you were at BDCA as a manager there. So I spent the bulk of my career covering BDCs, but I also covered banks, CIT, Silicon Valley Bank, which is very topical, at PacWest Bank. And a lot of these banks competed with BDCs in the origination of commercial credit. And they were also publicly traded. So, public investors were looking for the best relative value opportunities. That investor base varied, whether it was a hedge fund, a mutual fund, or an individual investor at an RIA. So, what I learned from covering BDCs for close to a decade was a pattern for recognition of trends and also understanding what investors cared about. With so many BDCs available for investment in the public markets, I got good at asking questions, doing the work, and challenging market assumptions. And ultimately, it led me to my third phase where I'm at today. And that took a stop at Owl Rock in 2020, where I was approached by the founders to essentially create a new role as their BDC product specialist. What I was asked to solve for them was to attract new equity investors to their public BDC and then also debt investors to their BDC franchise. At the time, Owl Rock's BDC was trading about 0.75 NAV, coincidentally, kind of about the same time today. Different though, it was levered at 0.5 times. And the unsecured debt market for BDC investors was very, very thin. Owl Rock had 5 BDCs and was in the process of creating a new non-traded BDC when I joined. And that's the product type that I think is in the media the most today, with redemptions and tender offers being the most recent topic du jour. So shortly after I joined Owl Rock, the company merged with Dial, and it's what is now Blue Owl today. Over the course of 3 years, Blue Owl had tremendous success, but I started to get the feeling that the game was changing dramatically, really, in 23, as everyone kind of rushed into private credit. I thought direct lending was on a path to peaking in terms of its returns and then also reverting back to the norm. And that's kind of how I found my way to SLR, where I'm at today. I had a thesis that private credit access was everywhere. Alpha would be from a strategy that was beyond direct lending. And SLR is viewed as a first mover in terms of specialty finance, commercial finance, and also in BDCs. And SLR today, in terms of my role, has 1 public BDC, 3 private BDCs, and then we're in the lab developing a semi-liquid BDC.
For our listeners who might not be as familiar with BDCs, what's kind of the 1 minute kind of overview, and maybe if you could compare to like a CLO structure?
At its core, BDCs are very similar to CLOs. Simplest form, a BDC is simply a commercial lending investment vehicle, or really a wrapper for investors to access the ownership in a diversified pool of private credit assets. Interestingly, the vehicle has been in existence for over 45 years, created in 1980 by Congress as an amendment to the Investment Company Act to provide growth capital to small and middle market businesses. Some differences. BDCs are regulated as an investment company. They are subject to SEC regulation under the 40 Act. And BDCs are registered investment companies, which essentially make their income a pass-through for investors and exempt them from the double taxation of federal taxes. Now, the key thing here, as you know, in order to do this, a BDC must distribute 90% of its earnings to shareholders.
So the way I think about the difference between CLOs and BDCs is that maybe a CLO equity investor might be targeting kind of like mid-teen returns, and they get that by investing in a portfolio of assets that I think are going to be, much more conservative than your typical BDC. So like private credit CLOs might have investment loans that have a spread of like SOFR plus 5%, whereas I think BDCs are going to target generally stuff that's like maybe SOFR plus 7. But then the CLO is going to employ, the CLO is not an investment company, so it employs leverage that, can be up to 8 times, whereas the BDC is levered 2 turns at the most. The CLO, I think of it as like, more leverage on a more conservative and more diverse pool of assets, whereas the BDC is less levered and has kind of like a higher return target for its asset level investments.
I think that's a great frame, comparing and contrasting a BDC versus a CLO as leverage. And one of the things that I think gets underreported and appreciated with BDCs in terms of the growth of the vehicle to, I think it's close to 600 billion of AUM today, is a change in 2018 that allowed BDCs, which you brought up, has leverage, regulatory leverage to 2 times. Previously, it was 1 times. And that changed the game in terms of the end ROEs distributed for investors and investors, whether that's an institutional investor, whether that's an insurance company or a private wealth investor. And the math is simple with 90% distribution requirements. And essentially, your dividend is your cost of equity. So the way that I think about it is you've got a dividend yield, which for public BDCs is about 10% on NAV. You got leverage for the industry that's about 1.2 times. The break even yield to cover that today is kind of 10 to 11s. These are floating rate index loans that are based off of SOFR, usually 3-month. SOFR's at 3.7. Your all-in yields spread, which includes fees, is like 6 to 7.
So then publicly traded BDCs today are trading at substantial discounts to book value. What factors would you ascribe that to?
One, I think, is sentiment. Two, I think, is an expectation for losses. 3 would be a tremendous amount of uncertainty related to software loans in BDC portfolios. For me, should investors be buying discounted public BDCs? I think there is an attractive margin of safety priced in, but there are many unknowns about the ultimate credit quality of software. One other thing in terms of public BDCs, right? They trade. They're tremendously volatile. It's different than perpetually private BDCs, which don't trade by definition, and then semi-liquid BDCs, which provide quarterly redemptions. And sentiment from the media is weighing heavily on public BDCs. So today they're trading at 0.71 times NAV on a simple average basis and providing a current annualized yield close to 14%. Now, I think the market for public BDCs woke up in September. We're here and we saw each other in October. We're here in April. In September, the market for public BDCs woke up to an expectation that forward returns would look very different than historical returns. And that was a product of narrowing spread income and then also losses. And subsequent to that, in the first quarter, you saw more than 10 BDCs reduce their dividend. Risk has been dramatically repriced within the public BDC sector.
Do you or does your firm have any particular view on software loans, and if the market is correct in assuming that big losses are on the come, or if changes in software enterprise values are going to be more of a issue for the private equity firms that own these businesses?
Well, fortunately for SLR, because of our diversified private credit strategies focused on ABL, lender finance, life science lending, and then also direct lending, we can tactically allocate to the best risk-adjusted return we see across private credit. This has allowed us to say no when others may have needed to essentially deploy or buy the market. So using an example for our public BDC, we've got 14% of our portfolio in direct lending. Drilling down further, less than 2% of that is in software. So we're not taking a particular view on software that I think the industry with more than 20% has to take. I think that just speaks for itself in terms of kind of our position. But I think the reality of it in terms of what will happen for software is, one, a lot of us don't know. Even some of the most sophisticated technologists are trying to figure things out. But 2, it's really maturities. And the maturities in private credit portfolios, whether that's a BDC that has 21 or 22 heavy software vintage, is when essentially the lender needs its money back. And that vintage, it has a maturity really in 28. So I don't think you'll see deteriorating fundamentals or material fair market value write downs in the immediate term. I think that's more likely to be a 27 event. The counter argument to that is, in the liquid loan market, software loans for the first quarter saw their bids fall 8 points. So you're already starting to see the liquid markets price in a tremendous amount of defaults and ultimately losses with software credits.
Well, one somewhat optimistic thing is that the loans, the broadly syndicated software loans, they have traded down probably a total of like 10 points or thereabouts, but they have stabilized at about 90 cents on the dollar. That feels much better than, if every day it was kind of another step function lower, that wouldn't feel good. So the BDCs are trading at these substantial discounts. And I think kind of like the fundamental thing you're saying is, hey, look, too much money was raised in private credit and the loans ended up being done at spreads that maybe were too tight and to businesses that were maybe more risky than what a BDC would have lent to 5+ years ago. Is that the fundamental challenge that the overall industry is kind of grappling with?
I would quibble with the view that BDCs moved further out on the risk spectrum as a requirement to deploy capital. Really, what I think happened from the success in marketing and fundraising in what I'll call the semi-liquid BDC structure offered monthly. Think of Blackstone, Blue Owl, and Apollo as being the top three, either semi-liquid or non-traded BDC managers, is they were able to go up to larger middle market companies that blurred the lines in terms of their execution, there being the borrower's execution versus a broadly syndicated loan opportunity versus a private credit opportunity. And really that's compressed the yields that a BDC had received, both on the semi-liquid structure, but also the public BDC structure, because a BDC manager has co-investment exemption to essentially invest across products. And so I think it's a combination of declining NIM from lower illiquidity premiums on the assets that BDCs have invested in. To give you an example, in the fourth quarter, the new origination yield for public BDCs was in the mid nines. Again, I stated that public BDC required cost of equity was close to 10. Essentially, you're originating at a level that can't cover your cost of equity. And so some of the growth in the semi-liquid and non-traded BDCs allowed them to go to lower yielding investment opportunities. Just to put a fine point on it, the yield differential between a non-traded or semi-liquid BDC and a public BDC on a yield basis is about 300 basis points.
Oh, really?
So I think that really explains it in terms of what's going on. And then obviously you have the software related element, which really just kind of came out of the blue and caught the market by surprise.
But do you think BDCs would still be trading at like pretty substantial discounts without kind of the software overhang, or?
That's a great question. The way that I think about the last 6 months, I mean, essentially in September, mid-September, you had public BDCs trading close to NAV, we'll call it. Two things happened. One, you had the Fed reduce rates and then essentially indicate that they were going to reduce rates further in December. And then two, you had First Brands and Tricolor start to permeate the market narrative. And while that wasn't directly a private credit solution, it did kind of wake up the market to the evolution of a credit cycle. So I characterize the Q4 movement in public BDCs down about 15 points on price, really related to both of those instances, not to software. And actually, towards December, BDC started to rally a little bit. Fast forward January, Anthropic's event in February started to change things in the public equity market and then in the liquid credit market. And people started to wake up to software exposure. And that took another leg down for public BDCs and private credit. And that's where we're at today in terms of kind of the run on BDCs with redemptions.
So obviously the tender, like if you're a public BDC, you're not agreeing to buy back shares. You can optionally buy back shares if they're trading at a discount. You can, management or the board decides to do that. But if you're a private BDC, you're generally agreeing to buy back, 5% of shares or so each quarter. If you're an interval fund, the tenders are like a fund requirement. You have to do them. In private BDCs, I think people expect them, but they're not, required by regulation or anything like that. Is what's kind of driving the tender requests from the private vehicles? Is it that concern about, is it the general backdrop of, hey, private credit just isn't, maybe it's still attractive, but not as attractive as it was in 2022 or 23? Or is it just, I don't know, like one oversubscribed tender in our space leads to headlines that drive the next? How do you see it?
It's interesting. I mean, really, the spark in private credit was public BDCs. Again, going back to the timeline of what's happened over the last 6 months, public BDCs really sold off in September. And you didn't see any movements in IG. You didn't see any movement in bank stocks, publicly traded bank stocks. And BDCs, public BDCs, are close to 200 billion of assets, and they represent BDCs 30% of private credit. So it's meaningful. What you saw in the semi-liquid structure is a little bit different. And to your point on redemptions, I think there's a confluence of factors that have led to where we're at today. One, I think it's just an expectation that 22, 23, 24 returns are not to be replicated. Seasoning of portfolio for a lot of those funds. Really, the bulk of the product began in 21 with Blackstone and Blue Owl. And then you saw a lot of managers get into the semi-liquid structure. There's more than 50 today in market. And it's the yield as well. Yields have compressed substantially. And the illiquidity premium that private credit could take got to the tightest level in the fourth quarter in its history. So I think it's a combination of the NIM, and it's also the combination of an expectation for uncertainty and credit risks with software.
Well, one of the things that I guess has kind of surprised me a little bit about the headlines is that one of the bigger asset managers, they have a tender period and say 10% of shares are offered to be tendered and they agree to buy back 5%. Well, this is like pretty common headline, even kind of like a top story on Bloomberg News. But the thing about it, I guess from my perspective, is that if you're in a private vehicle and you're invested in illiquid assets, the tender's 2 times oversubscribed, well, you get back half your money. And then presumably you wait another 90 days, tender again, and maybe you get back all of it. Or in most cases, you would get it back in a year. So I'm kind of surprised that that is a story that makes it to the top of like my news feed. Do you see it differently or?
The liquidity of the semi-liquid structure is a feature, not a flaw. And I think that media and other people, whether that's traditional investment manager or a bank, try to frame it more as a flaw. The redemption limits built into direct lending funds, I think, have worked as designed so far. And more importantly, the structures allowed managers to avoid fire sale transactions of, to your point, illiquid assets. Now, I think there could be a view that investors maybe were misinformed by their advisor in terms of liquidity. Put plainly, they simply disregarded the semi-liquid feature that is, for me, clear in the offering documents. So I think the thing today, though, is there's currently about 6.5 billion of unmet demand for liquidity as an overhang. And as I see it, that's going to take a while to work through for the remainder of the year.
So one kind of like risk that's been highlighted in the press is, I guess, the fear that there will be a fire sale of some of these private credit loans. And the way I'm thinking about it is that, as you know, the private credit loans, they prepay optionally at a rate of about, 30% per year. So it's not like you're in a private equity fund where there's liquidity, I don't know in how many years, or venture, same thing. But here you're getting the cash interest every, month or 3 months, depending. And then the loans are just like you're getting the principal back, and the principal you get back might be in excess just from that of your tenders. And also, these funds may grow as well. So, that to me doesn't really set up a backdrop for a private credit fire sale on the come. Although, of course, I'd like to be invited if that's what's happening. But do you see a risk that these assets get fire saled so that investors can meet their tenders?
So mechanically, you bring up one form of liquidity that is available to a semi-liquid BDC in the event there is net outflows. And that is just the natural churn of private credit portfolios. Yeah, generally 30% of beginning assets are repaid for a BDC. I think in this environment, duration is going to be extended. So maybe that moves down to 20%. But regardless, to your point, just the nature of a private credit loan provides significant liquidity. Second point is in the fourth quarter, there was actually inflows, net inflows. And so fundraising, while it has decelerated for a lot of semi-liquid BDC managers, still remains pretty robust. The data for February, March is still decent. So that offsets the 5% quarterly outflows. And then also you have level 2 investments commonly structured in a BDC portfolio. That's generally about 10% of investment portfolios. It's higher in some instances. Now that does create mark to market or greater mark to market risk because those are traded. The level 2 investments are often broadly syndicated loans, but that is a buffer to meet, elevated redemptions if they remain high for long periods of time.
Again, in the private BDCs, the tenders are optional, right? So they're done at management's discretion. And I would assume management, if it came to it, which I don't think it would, but if it came to it, then they would just not do a tender. I mean, that would be better than trying to fire sale assets.
Yeah, and it's interesting. I mean, there's a lot going on, and semi-liquid BDCs followed what we'll call non-traded REITs in terms of its distribution arc. And you're starting to see some non-traded BDCs, closed-end funds, CLO closed-end funds that had outflows over sustainable periods of time, essentially toggle the structure to be publicly traded. So I think a manager has a fair amount of optionality in the structure to protect those that want to stay in and not fire sale assets and preserve essentially returns.
Well, that'll be maybe disappointing. Given the headlines out there, I guess maybe that'll surprise people, but that's certainly my view. With public BDCs trading at these big discounts, you mentioned investors are still allocating to private BDCs. They allocate at par or they NAV. There's no discount on the privates. So what's the rationale for somebody to do that with their capital?
Just to clarify, to subscribe to a semi-liquid BDC versus invest in a public BDC?
Correct.
So public BDCs have some barriers to entry for the traditional institutional investor. So I think you got to back up and unpack the market structure of public BDCs versus semi-liquid BDCs. Semi-liquid BDCs are typically thought of as being distributed to exclusively private wealth, but the reality of it is there is some institutions involved there as well. And in public BDCs, there is a structure called acquired fund fees and expenses that preclude investors on the institutional basis from getting more active in public BDCs. The reason for which some investors don't sell or redeem their non-traded and go into public BDCs is a lack of sophistication in terms of the investment due diligence to understand a manager and what's in their portfolio, and also the setup. So private wealth investors oftentimes partner with alternative investment managers across product set. And there is a deep vetting process in both IDD and ODD on those private securities. It doesn't exist as much within private wealth on RIAs for active stock picking for public BDCs. And getting back to my point in terms of the barrier to entry for public BDCs, there really isn't a lot of beta products in terms of mutual funds or ETFs that invest in BDCs. So it gets complex, and also the volatility in public BDCs. There is a beta, does scare people. And I brought up a large margin of safety in terms of the discount to 1231 NAVs implied in prices today. The reality of it is if either the S&P 500 or the Russell 2000 is down 10% over 5 days, public BDCs will be down further naturally. I think the beta of BDCs has disjointed over the last 6 months. It used to be a 1.2, but needless to say, if public equities are down, again, 10%, you can make an argument public BDCs will be down 12% just by their nature.
For investors that are tendering today from their private BDCs, I mean, is there like some no-brainer asset class that they're kind of like rotating the capital into? Or is kind of the dynamic that actually private credit is still attractive, but maybe not as attractive as it was in 2022 or 23, and it doesn't make sense for people to tender and, I don't know, buy the S&P 500 at or near record highs? How do you think the end investors are kind of thinking about it?
The majority of private credit is in direct lending, and that is sponsor back companies that are levered 5 to 6 times. The subordination is essentially the equity investment, loan to values of 40%. However, it's dependent on the cash flows, and those cash flows can be volatile. And so if you look across Blackstone, Blue Owl, Ares, Apollo, HPS, Oaktree, BlackRock, Golub, majority of the semi-liquid products lend and include direct lending. I think there's 2 conclusions wealth investors are kind of taking away from this is, one, am I over allocated to direct lending? And am I getting duplicative exposure? Because a lot of BDC managers will club up in terms of their participation in a private credit solution. So oftentimes there is duplicative positions in what I would say a Blue Owl and a Blackstone, just to throw out an example. So investors are therefore looking for adjacencies. And that was the thesis that led me to join SLR from Blue Owl was asset-based lending. And I think there has been a healthy amount of articles written by the media about ABL, about its secured collateral, whether that's finished goods inventory or accounts receivable, that give people a greater degree of comfort. And also the trade-off of illiquidity premium and cash flow versus a complexity premium. That business, whether it's ABL or ABF, varies and the scale varies. And so people are looking to expand their efficient frontier from a primarily direct lending portfolio to essentially an all-weather private credit strategy, which includes, infra as well.
In your PA, do you find it interesting to invest in some of the publicly traded BDCs outside of SLR? Is that something you kind of dabble in, given your skill set?
I wish that was the case because it's where I'm very passionate. However, at SLR, policy is to not allow us to invest in public BDCs. So I do get often asked about specific BDCs. And again, getting back to the co-investment exemption allowed for a private credit manager, there is a lot of applicability of a public BDC and a non-traded. So if someone's in a non-traded or semi-liquid BDC, they oftentimes will look at the public BDC, but the portfolio can be very different in many instances. So they will be looking for more information. And oftentimes I get a lot of questions about that, just given my background. And Shiloh, how are you viewing things in terms of your PA? I mean, we've long history of looking at public BDCs. And I know you guys started back in the day, a BDC mutual fund. So how are you thinking about a 0.71 NAV and 13% dividend yield?
Well, I think I used to find BDCs more attractive than I do today. So if you rewind the clock like a decade, one of the things I loved about investing in BDCs was that, if you invest in, for example, anything in the S&P 500, you're kind of making a call on what you think the true value is, maybe versus the current share price. Whereas what's fun about BDCs is that they tell you, 4 times a quarter, exactly at least what they think their book is worth. When you're buying a BDC at a discount, that to me felt a little bit more secure, I'd say, than just kind of coming up and saying, okay, well, I think Meta or Google or something is undervalued. And when I was a younger man, I guess I thought, hey, the bigger discounts must be the better values. In my experience with that is that did not plan out. So the market was actually discounting some BDCs because the managers had underwritten and continued to underrate poor performing loans. Then also there's like a fee component in there as well. You're trading at a discount, but the manager and OpEx, they get their cut every year. So it's not like you're buying a static pool of loans, today at a 30% discount. The other experience I had was just the BDCs are so volatile. And I guess this ties back to your point for why some bigger institutions are just doing privates. But it's like, during COVID, a lot of these BDCs were cut in half. And for a portfolio of loans that are largely senior and secured, where your upside is just like basically the dividend yield, which in a normalized time is like 10%. Now, as you said, it's like 14. If I'm buying something and it's like, yeah, I'm making 10 is kind of 10% is the upside case. I'm down 50 in some kind of like recessionary environment. That doesn't skew super favorably for me. And then also, there's a tax part of it too, right? Where depending on which state you live in and your tax bracket, like the BDC income is ordinary. You're going to lose maybe a third of the dividend yield to taxes. So I think that part's a little bit less compelling. A lot of the public BDCs get knocked for higher fees. So if you're in a private vehicle, most likely there's some like institutions in there that pushed pretty hard on the manager and got a good, a reasonable set of fees. Whereas in the publics, fees are higher. You kind of add all that up and it's kind of hard for me to get excited about BDCs.
You pull out a couple interesting threads that I hear commonly. I commonly hear investors lament about their attraction to heavily discounted BDCs. And in my experience, heavily discounted BDCs end up being more value traps than opportunities, just given the asymmetry provided in the underlying credit instruments. And then also the negative feedback loop that exists. We were talking leverage and it can work against you. And so if you're levered at 1.2 times and you start writing down NAV per share 5% annually, your leverage expands. And the governor on the unit economics is essentially your cost of capital. That capital governor is your investment grade rating. And what you've seen recently is a couple BDCs start to get downgraded. And I was interestingly looking through the 13F filings in the fourth quarter for those that bought the dip in September for public BDCs. And a majority of the new investors there were buying the most heavily discounted BDCs. And coincidentally, those BDCs are down 20 to 25% further in the first quarter. So BDCs require a tremendous amount of due diligence, active management. And then the other interesting thing is it takes time for the market to essentially heal. And those buyers that, had a mistake or a learning lesson from investing BDCs essentially get turned off from it. Yet they're the decision maker in many instances still at that institution that can allocate. And that takes a while to heal. I think that'll take some time.
Chris, is there anything else topical in the BDC space that we didn't cover today?
innovation is one thing that maybe is under discussed, whether that's unitranche and moving from the blend of a first lien and a junior debt to one tranche, or essentially the distribution of BDCs. And, we're talking a podcast, and it's interesting. We've been following corporate credit markets bulk of our career. And if you wanted to talk or hear from a CIO at Blackstone or Oaktree, you could learn from Howard Marks and Byron Wien. Now everyone at a diversified investment manager has a microphone, as a podcast. And there's a lot of individuals out there writing on Substack, on Twitter about BDCs. And that is presenting a tremendous amount of confusion for people. It's hard to unpack what is fact from fiction. And managers are obviously incentivized to put out how they view the world. And that is inherently biased. So I think innovation will lead us out of this as well. I think there will be structures that diversified alternative investment managers pick up. And there's going to be an opportunity, whether that's in private credit secondaries or opportunistic investing. I think there's going to be a tremendous amount of opportunity on the other side of this. It may take some time, but I think that's one thing that will come, because the private equity secondary market has been in existence for a while, and the private credit secondary market is pretty nascent, but you're getting a lot of attention from the sales of New Mountain and Blue Owl and a lot of other managers in terms of, the headlines reported by Bloomberg and the Wall Street Journal.
My closing questions always describe a CLO in 30 seconds. I know you work in BDCs all day, but want to give it a go?
Sure. Whether that's a broadly syndicated loan or a middle market CLO, definitionally a collateralized loan obligation, with the left-hand side of the balance sheet being focused on oftentimes below investment grade rated corporate credit. And then the liabilities being tranched out from AAA all the way down to single B. I know you're focusing on the equity side in middle market CLO equity. And there's a fair amount of overlap and comparability between CLOs and BDCs. Ultimately, it shakes out, I guess, a low teens, mid-teens ROE, and it requires a tremendous amount of active management and knowing credits and doing the work.
Good stuff. Chris, thanks so much for coming on the podcast.
How'd I do?
I don't give you guys grades at the end, although I was thinking about maybe having an award at year end for the best answer. What's a CLO? I describe it as a simplified bank. One of my previous podcast guests, Brad Larson, described it as a loan fund with a lot of leverage, which I think is good. I think yours was good as well. So thanks again. Really enjoyed our chat.
The content here is for informational purposes only and should not be taken as legal, business, tax, or investment advice, or be used to evaluate any investment or security. This podcast is not directed at any investment or potential investors in any FlatRock Global Fund. All statements of opinion or forward-looking statements herein are based on current market conditions and should not be construed as guaranteed as future events, and are subject to change at any time without notice. For definitions of words used in this podcast, please go to flatrockglobal.com/glossary. Risks. CLOs are subject to market fluctuations. Every investment has specific risks, which can significantly increase under unusual market conditions. The structure and guidelines of CLOs can vary deal to deal, so factors such as leverage, portfolio testing, callability, and subordination can all influence risks associated with a particular deal. Third-party risk is counterparties involved: the manager, trustees, custodians, lawyers, accountants, and rating agencies. There may be limited liquidity in the secondary market. CLOs have average lives that are typically shorter than the stated maturity. Tranches can be called early after the non-call period has lapsed. ETFs are subject to market risk, including the potential loss of principal, and may trade at premiums or discounts to NAV. General disclaimer section. FlatRock may invest in CLOs managed by podcast guests. However, the views expressed in this podcast are those of the guest and do not necessarily reflect the views of FlatRock or its affiliates. Any return projections discussed by podcast guests do not reflect FlatRock's views or expectations. This is not a recommendation for any action, and all listeners should consider these projections as hypothetical and subject to significant risks. References to interest rate moves are based on Bloomberg data. Any mentions of specific companies are for reference purposes only and are not meant to describe the investment merits of, or potential or actual portfolio changes related to securities of those companies, unless otherwise noted. All discussions are based on US markets and US monetary and fiscal policies. Market forecasts and projections are based on current market conditions and are subject to change without notice. Projections should not be considered a guarantee. The views and opinions expressed by the Flat-Rock Global speaker are those of the speaker as of the date of the broadcast, and do not necessarily represent the views of the firm as a whole. Any such views are subject to change at any time based upon market or other conditions, and Flat-Rock Global disclaims any responsibility to update such views. This material is not intended to be relied upon as a forecast, research, or investment advice. It is not a recommendation, offer, or solicitation to buy or sell any securities, or to adopt any investment strategy. Neither Flat-Rock Global nor the Flat-Rock Global speaker can be responsible for any direct or incidental loss incurred by applying any of the information offered. None of the information provided should be regarded as a suggestion to engage in or refrain from any investment-related course of action, as neither Flat-Rock Global nor its affiliates are undertaking to provide impartial investment advice, act as an impartial advisor, or give advice in a fiduciary capacity. Additional information about this podcast, along with an edited transcript, may be obtained by visiting flatrockglobal.com. This material is for general information purposes only and does not constitute an offer to sell or a solicitation of an offer to buy any security. TCW, its officers, directors, employees, or clients may have positions in securities or investments mentioned in this publication, which positions may change at any time without notice. While the information and statistical data contained herein are based on sources believed to be reliable, we do not represent that it is accurate and should not be relied on as such, or be the basis for an investment decision. The information contained herein may include preliminary information and/or forward-looking statements. Due to numerous factors, actual events may differ substantially from those presented. TCW assumes no duty to update any forward-looking statements or opinions in this document. Any opinions expressed herein are current only as of the time made and are subject to change without notice. Past performance is no guarantee of future results. All investing involves risk, including the potential loss of principal. Market volatility may significantly impact the value of your investments. Recent tariff announcements may add to this volatility, creating additional economic uncertainty and potentially affecting the value of certain investments. Tariffs can impact various sectors differently, leading to changes in market dynamics and investment performance. Copyright 2026 TCW.